Look, if you think the current market is just another dip waiting to be bought, you're reading from the same playbook that led to the biggest bloodbath of the 20th century. Everyone loves to talk about 1929, but 1973 is the ghost in the machine that nobody wants to acknowledge, because acknowledging it means admitting we're currently walking into the exact same wood chipper. Back then, Wall Street wasn't just optimistic. It was suffering from a terminal case of invincibility syndrome. You had legends like Sir John Templeton, a guy who put up 15% annual gains for nearly 4 decades. Warning that this time is different are the 4 most expensive words in the English language. But nobody listened. Why? Because when you're riding a 20-year economic sugar high post-World War II, you stop looking at fundamentals and start looking at the mirror, falling in love with your own reflection. In the early 70s, it wasn't just about stocks. It was about a cult of personality centered on the Nifty 50. These weren't speculative gambles. These were blue-chip juggernauts: Coca-Cola, Xerox, Polaroid, McDonald's. Companies that were so solid, so dominant, that your grandfather would have told you it was a sin to ever sell them. We're talking about an entire generation of investors who convinced themselves that gravity didn't apply to these specific tickers. They treated these companies like sovereign wealth funds, locking them away in portfolios, completely ignoring the fact that they were paying insane premiums. It was a massive, collective delusion. You had investors lining up to pay 80, 90, sometimes 100 times earnings for companies that were, let's be honest, just selling soda and fast food. They built an entire financial religion on the idea that growth would compound into infinity, ignoring the reality that every bubble, no matter how bulletproof it looks, is essentially a grenade with the pin halfway out. We think we're smarter now because we have apps, high-frequency trading, and AI, but the plot of the movie is exactly the same. We're just using shinier, more expensive special effects to hide the fact that the underlying logic is completely broken. Now, let's stop playing around and actually look at the math, because this is where the one-decision investment strategy stopped being a rational thesis and officially morphed into a massive, systemic suicide pact. Back in 1972, the average P/E ratio for the broad market was a humble 15. It was respectable. It was the kind of number you could take home to your parents, and they wouldn't call the authorities. It represented a world where companies were valued on actual, present-day cash flows. But the Nifty 50? They were operating in a completely different solar system, a reality distortion field where gravity was apparently optional. You had Polaroid sitting at 90 times earnings. McDonald's was trading at 86. Xerox was at 49. To put that in perspective for the guys trading today, those aren't growth valuations. Those are priced for absolute, divine perfection valuations. The market was effectively screaming that these companies were immune to recessions, immune to rising oil prices, and immune to every single cyclical law that had governed finance for the previous 2 centuries. And here's the lethal trap that most people miss. When you buy a stock at 90x earnings, you aren't investing anymore. You are gambling on a fantasy where the company not only maintains its market dominance, but accelerates its growth into the stratosphere indefinitely, without a single hiccup, for the next 20 years. You're pricing in a future where everything goes perfectly right, every single quarter, with zero margin for error. But the market isn't a charity. It's a meat grinder that loves to punish this kind of arrogance. The tragedy of the Nifty 50 wasn't that the companies were garbage. They were actually some of the most efficient, profit-generating machines ever built, but they became the ultimate victims of their own hype cycle. They became so popular, so fundamentally overowned by every single pension fund, mutual fund, and institutional giant in the country that they literally sucked the liquidity out of the rest of the market. We saw a level of concentration that is genuinely terrifying when you look back at the charts. At the peak, just 5 of these companies, that's it, just 5, accounted for 25% of the entire US stock market valuation. Think about the insanity of that. 1 out of every $4 invested in American equities was riding on the backs of 5 corporate boards. That is the definition of fragility. You weren't holding a diversified portfolio. You were making a massive, concentrated, all-in bet that these companies wouldn't trip on their own shoelaces. And because they were one-decision stocks, the mentality was that selling them was essentially heresy. So, when the macro environment finally turned, when oil spiked and inflation started eating the middle class alive, there was no exit liquidity. Everyone was trapped in the same burning building, looking for the same narrow exit, while the valuation multiples did the only thing they could do. They collapsed under their own weight. Then, 1973 hit like a freight train. And it didn't just rattle the windows, it tore the house down. It was a perfect storm. Oil prices quadrupled overnight. Inflation morphed into a monster that started eating double-digit chunks of purchasing power, and Nixon effectively shredded the gold standard, throwing the global monetary order into a tailspin. The dominoes didn't just fall, they nuked the entire portfolio landscape. The market plunged 50% in 2 years, marking the most brutal bear market since the Great Depression. And remember the bulletproof Nifty 50? They didn't just dip, they got absolutely vaporized. Polaroid, down 90%, McDonald's, down 70%. It wasn't the cute little V-shaped recovery that we've been conditioned to expect after the pandemic. It was a slow, agonizing financial obituary that dragged on for 8 years. Investors who thought they were buying eternal growth found themselves trapped in a purgatory of stagnant prices until 1981. They learned the hard way that when the macro environment turns, overpriced blue chips don't just correct, they get liquidated. Now, look at today's Magnificent Seven. They represent roughly 36% of the S&P 500. Investors are worshiping Nvidia, Tesla, and Microsoft with the exact same zeal that the 70s crowd had for Xerox and Avon products. We see Tesla trading at over 200 times earnings, and instead of calling it what it is, a massive speculative bubble, the street calls it AI disruption. It's the same bedtime story, just with a fresh coat of paint and shinier special effects. We're staring at a market that is so top-heavy it's practically leaning over a cliff, and yet everyone is convinced that this time the rules of finance simply don't apply to us. We've become arrogant. We've become complacent. We've convinced ourselves that because we have algorithmic trading and real-time data, we've somehow conquered the cycle. But history doesn't care about your trading app or your high-speed execution. Warren Buffett summed it up best. What we learn from history is that people don't learn from history. We are back in the exact same spot, staring at a market concentration that should be keeping every portfolio manager up at night while whispering those 4 most expensive words in the English language. This time, it's different. It's not. The players have changed, the tech is faster, and the hype is louder, but the underlying trap is identical. We're all just players in a game of musical chairs, and the music is starting to skip a beat. Look, if you're tired of playing this game of musical chairs and you want to actually understand how the market really moves, not just the bedtime stories they feed the masses on mainstream news, then consider hitting that subscribe button. We're dissecting the patterns that everyone else is ignoring, and if you want to stay ahead of the next bubble before it pops, you're in the right place. The crash isn't a matter of if, it's a matter of when. And when the music stops, there won't be enough chairs to go around. You've been warned. History doesn't repeat itself, but it sure as hell rhymes, and right now the rhythm is looking disturbingly familiar. Don't be the liquidity for someone else's exit.